Warren Buffett is heavily regarded as a legendary investor or an investing god. He even has the nickname the Oracle of Omaha. But was it always this way? Was he born from wealth? How did someone seemingly so disarming from Nebraska become one of the world's most powerful and richest men?
Berkshire Hathaway's Warren Buffett is trying to set the record straight.
Let's take Warren Buffett of Omaha, Nebraska.
The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule.
Those who fail to learn from history are doomed to repeat it.
Stocks have been rising at a rather rapid rate. You don't need tons of IQ in this business. I mean, you have to have enough IQ to get from here to downtown Omaha.
Starting from scratch to amassing $110 billion in net worth is a seemingly impossible task. So let's start from the beginning of Warren's life in today's story. At the age of 7, Warren read a book borrowed from the library titled 1,000 Ways to Make $1,000. Soon after, Buffett began selling juicy fruit gum door to door.
I went into business very early, and I wasn't going to make more than a nickel a week unless I started selling Coca-Cola door to door. I sold gum door to door, or sold Saturday Evening Post, Liberty Magazine, Ladies Home Journal, you name it.
He would sell the gum in packs of 5 for a nickel, making 2 cents of profit per pack that he sold. Now keep in mind, this is in the year 1937, where the value of $1 back then is worth about $19 today. After selling gum for some time, he would then switch his product of choice to Coca-Cola. He would sell these door to door as well for 5 cents a bottle, and since he purchased a 6-pack for 25 cents at his grandfather's grocery store, he would make a 5-cent profit on each 6-pack that he sold. Essentially, Warren Buffett started his career flipping products, not so different than what many of us can do online these days. At the age of 11, his father, who was a stockbroker, took him to New York. As you can probably guess, he visited the New York Stock Exchange, which was where he became enamored with the stock market. Warren realized that he could make a lot more money investing in stocks. There was, however, just one problem. He didn't really have the money to invest in stocks quite yet. This visit to New York would ultimately cement the idea that he wanted to invest and that he was extremely motivated to make it rich. Buffett famously even told a friend that he would be a millionaire by the time he turned 30, or he'd jump off the tallest building in Omaha, which is his hometown. As he began to become more interested in the stock market, Buffett would pool all the money that he had with his sister and bought 6 shares of Citi's service known as Citgo Petroleum at $38 a share. He chose this specific stock after visiting his dad's brokerage and doing some research that would lead him to determine that Citi's service was extremely undervalued. He did this all at the age of 11. Now, when I was 11, mind you, I was just trying to evolve my Pikachu into Raichu. Anyways, this early investment into Citgo would go on to be what he describes as an early lesson in the patience of investing. Like many of us normal investors, in the first few months of owning the stock, it dropped from $38 a share to $27 a share, or a 29% decline from where he invested. At this point, Buffett was anxious and scared, but continued to hold the stock until the price bounced back to around 40, at which he then sold and took some profit on his trade. After selling his shares and probably feeling relieved that he didn't lose any money on the trade, he watched the stock soar to $200 a share. His original belief that the stock was undervalued would prove to be correct, but it was too late. Sometimes even if you find a stock that you believe is undervalued, it might take months or even years for the market to reach the same conclusion. This early lesson on patience and not panicking would greatly help him in his life and form a cornerstone of his investment strategy in the following years. So how did his investing journey evolve from here? There's still a lot of gaps to fill from his skill set at the age of 11 to now where Warren Buffett is basically regarded to as the most legendary investor of all time. To answer that, we need to discuss his upper education and the pursuit of more capital. Fast forwarding to his high school years, the name of the game was capital accumulation. Buffett would continue his various businesses, from delivering weekly magazines, selling golf balls, selling stamps, and detailing cars. Needless to say, he was a hard worker, and obviously it doesn't end there. At age 15, Buffett made more than $175 a month delivering Washington Post newspapers, which in today's dollars is roughly $2,733 a month. Buffett also had a notable business in his teens, which was running pinball machines in 3 different locations. Within a year, that business was sold for $1,200 as well. By the end of high school in 1947, Buffett had $5,000 worth of savings, which is roughly worth about $63,000 today. Now that Warren Buffett had some capital, he needed to expand his investing skill set. For Buffett, he didn't want to go to college and was eager to remain a full-time entrepreneur, and after all, this was working for him quite well already. His father, however, did not approve and urged him to go to college. Buffett wasn't very happy with this, but followed through with his dad's request, enrolling at the Wharton School of Business at the University of Pennsylvania. It was there that he didn't really have a great time, and he felt that he knew more than his professors. In later interviews, he even admitted that he was rebellious and even shorted AT&T stock, a dividend stock that many professors at the time had in their retirement portfolios.
AT&T was the stock that all teachers owned for their retirement, paid $9 a year dividend. It was the ultimate safe stock. So the teachers all owned it. So my teachers found me a big pain in the neck, but they did think I knew a lot about stocks. In fact, and so I shorted 10 shares of AT&T and brought the confirmation to school and showed these teachers that I was shorting the stock they were counting on for their retirement. I was a real pain in the neck for a while.
Buffett later transferred to the University of Nebraska, where he enjoyed every single minute, and he would later reflect on his time at Nebraska and said that the business skills that he developed there gave him a competitive edge throughout his career.
I enjoyed every minute of it at Nebraska. I mean, I don't think they could quite believe it when, after 2 years at the Wharton School at Pennsylvania, I said, I want to transfer to Nebraska.
He continued to be frugal, expand his business ventures, and he actually developed a habit for reading to increase his breadth of knowledge on how the world worked. To this day, Buffett still devotes much of his time to reading and believe it's a large contributor to his success. After graduating from the University of Nebraska, though, he still needed a mentor and to work with somebody. So he attended Columbia University for graduate school after finding out that Benjamin Graham taught there. This was a pivotal moment for Warren, because if you don't know who Ben Graham is, he's considered the father of value investing and most famously wrote the book, The Intelligent Investor. From 1936 to 1956, Graham's company achieved a stellar 20% annual return for its investors. If you had invested $10,000 with Ben over those 20 years, you would have walked out with just over $383,000, which is about $3.6 million in today's value. While Buffett was actually rejected from his first choice, Harvard Business School, he was excited to learn from Ben Graham, as Ben was a large influence on Buffett and his investing philosophy. In fact, Buffett actually says that Ben Graham was the second most influential person in his life, the first being his father. So what did Buffett actually learn from Graham, and how did it actually contribute to him becoming so rich? There were 3 core principles that Graham taught Buffett. Number 1, always analyze the long-term evolution and management principles of a company before investing. Number 2, always protect yourself from losses by diversifying. Number 3, always focus on safe and steady returns over crazy profits. Warren would internalize these principles and even landed a job at Ben Graham's partnership after school, earning $12,000 per year. Just 2 years after joining, however, Graham retired and closed his partnership, thus causing Warren to start his own partnership, which is basically at the same time he met Charlie Munger, his friend and business partner for years to come. Now you may be wondering, what investments did Buffett make that grew his relatively small fortune into becoming one of the wealthiest people in the world? From the years of 1956 to 1969, Warren would amass a personal fortune by starting partnerships and investing on his investors' behalf. His initial partnerships were funded by friends and family, and the compensation formula was quite simple. The investors received 4% interest on their money from the partnership. After that threshold, Buffett got 50% of the net profits, and the limited partners also got the other 50%. The fee structure also noted that Buffett would take 25% of the downside of any of the investments, and Warren once said, quote, "I got half the upside above a 4% threshold, and I took a quarter of the downside myself, so if I broke even, I lost money." Some of his largest wins include the following. In 1961, he made his first large investments in Sanborn Map Company, which had a publication business and also an investment trust. At the time, the company's stock was trading at $45 a share, but Buffett found that the investment trust alone would be worth $65 a share. Thus, he concluded the publication business was worth negative $20. This made no sense to Buffett, and he purchased 23% of the company's shares, got a seat on the board of directors, and eventually convinced the board to repurchase the shares at fair value. Just like that, Buffett obtained a 50% return in just 2 years. In 1962, Buffett hit his first major milestone of becoming a millionaire at the age of 32. Later that year, he took control of a textile manufacturing company known as Berkshire Hathaway. The Buffett partnerships would become the largest shareholder of Berkshire Hathaway, and his early investments with Berkshire included American Express at $35 a share, and buying 5% of Walt Disney. By 1967, just 5 years later, his American Express shares would hit $180 a share, making the partnership $20 million in profit on a $13 million investment. By 1969, Buffett is now worth $25 million, just 7 years after becoming a millionaire for the first time. Throughout the 1970s and 1980s, Warren would continue his shopping spree and incredible returns through Berkshire Hathaway, which at this point was no longer a textile business, but more of an insurance company and holding company. Notable investments included ABC, The Washington Post, and most notably, 7% of Coca-Cola stock in 1988 propels his wealth even further. Today, 7% of Coca-Cola stock would be worth around $19 billion alone. It is also in the late 1980s when Warren Buffett becomes a billionaire. Now, just for reference, in order to go from $1 million to $1 billion in just 28 years requires a 28% compounded annual growth rate. This wasn't always an easy linear journey though. So in 1973 to 1974, during the financial crisis, the Dow Jones lost 45% of its value during this time. Buffett lost 50% of his net worth. Additionally, in 1987, during the market crash in October, Buffett also lost $342 million. Although the journey was rocky, he stuck to the guiding principles that he learned early on. By protecting his losses through diversification and focusing on safe and steady returns, Buffett never got completely wiped out. So how is Warren Buffett able to consistently invest in winners over the long term, and how can we do this? Recently, Berkshire Hathaway's 2020 to 2022 performance has caught up with the high-flying ARK Innovation ETF. Warren Buffett's investing style follows that of his mentor, Ben Graham, and that's value investing. Buffett looks for companies where their stock valuation is lower than what it should intrinsically be worth. Then, over time, the market will eventually favor these undervalued stocks and price them correctly. In the words of Ben Graham, quote, "In the short run, the market is a voting machine, but in the long run, it's a weighing machine." Two other mindsets that Buffett has when picking investments is to not follow crowds and to approach them with a long-term view. There are two great quotes from him about this. The first is, quote, "The most important quality for an investor is temperament, not intellect. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd." Buffett's focus on thinking for himself and investing in businesses he can easily analyze has earned and saved him a lot of money. For instance, he didn't suffer that many losses from the 2000 dot-com bubble because he avoided the unproven and hype companies of the time. The second quote that Buffett has is, quote, "If you are not willing to own a stock for 10 years, don't even think about owning it for 10 minutes. As we'll see later on, Warren Buffett has held many of his stocks for decades on end. While he still sells stocks when the fundamental story of the company changes for the worse, he approached most of his investing with the mindset of owning the stock forever. Lastly, Buffett has long talked about not fearing market crashes and times of correction. For instance, if you believed and invested in a company at $100 a share, shouldn't you be excited to buy the same stock at $80 a share? As Buffett says, quote, "Opportunities come infrequently. When it rains gold, put out the bucket, not the thimble." Personally, I found that in times of market declines is when I'm tested on whether or not I truly believe in the companies I'm invested in. Okay, so what's currently in Warren Buffett's portfolio as of today? Now, here's a great table that breaks down his portfolio allocation. As we can see, his top holdings have remained relatively the same and haven't changed for years. It's funny to think that he went from selling bottles of Coke for a couple of cents profit to owning 7% of Coca-Cola, the entire company. Wild. So Warren Buffett, while he does own around 45 to 46 different holdings, his top 5 still represent close to 80% of his portfolio. Some interesting changes came to his portfolio this past quarter, which included an addition of NU Holdings and Activision Blizzard. NU Holdings is a Brazilian fintech company, while Activision is a video game company that is being acquired by Microsoft, most famous for making games like World of Warcraft and Call of Duty. Ultimately, Buffett's total allocation to these two companies is just 0.59% of his overall portfolio. Now, to put this into context, if you have a $10,000 portfolio, a 0.59% allocation would be the equivalent to $59. So while they are interesting additions to his portfolio, it doesn't really account for that big of a portion of his total portfolio. Warren Buffett still invests the majority of his money in just a few holdings. He's using his intimate knowledge of companies and financials to have concentrated positions on the ones that he's most bullish on, and that's something that you can take away from this video. Invest in what you know, invest for the long term, and invest for safe and steady returns over unproven, hyped up companies. Staying invested over a long period of time can really compound your returns for a lifetime. And that, my friends, is how Warren Buffett became a legendary investor and remains an investing god. Thank you guys for watching, and I'll see you in the next one.